In this video, Sunday 20th of July 2013. Hope you had a good week's trading. Well, something quite different. In today's video, I want to talk about central banking. And you might have noticed on the website I'm getting quite interested in the bigger picture and some longer term trades, two of which have worked out quite nicely in the last several months. So we had short Aussie dollar a couple of months ago, long crude in the last few weeks, and the feedback from those videos has been absolutely tremendous, so thank you to everybody who sent kind of good wishes about those calls. They've worked out nicely kind of so far, so we'll keep on tracking those kind of going forward. But there are some interesting plays in terms of the bigger picture and what the central banks are doing, and I've got some ETF ideas that I want to put forward. Not things that are going to happen immediately, but I'm kind of looking at over the next kind of several months, so let's start. First thing to say, Emini-Watch is about two things. First of all, you need to take control of your financial future. Don't rely on financial planners, brokers and so on. Sorry, I know Emini-Watch has a number of financial planners that subscribe to the site, but sorry to say, I think everybody should be looking after their own money. You need to educate yourself. You know, the financial markets is just jargon, stopping you kind of understanding what's going on. And access has never been better. You know, 30 years ago, the man in the street didn't have a brokerage account, but now everybody has access to extraordinary information and access to trade, a whole range of different markets. And the second thing that Emini-Watch is about is don't assume the old rules apply. In my view, we're through the looking glass. Everything changed after the global financial crisis, and what did work over the last 30 years might not work over the next 30 years. And one of those kind of rules of thumb was, never fight the Fed. I'm just going to put forward some potential trades that might be kind of against that kind of traditional mantra of not fighting the Fed. So let's kind of go through this. First thing to say, banking is inherently an unstable business model for a few reasons. First of all, it's based on fractional reserves, which means you lend more than you borrow. So you have to put down something between 8 and 12% kind of capital down, and you lend out a multiple of the capital that you have in the bank. The second thing is there's an asset liability mismatch, which means that you're borrowing short term, so your deposits that you take in from depositors are at call money. So if they're checking accounts, they kind of can go overnight, or they're up to kind of 90-day money where the money can leave after 90 days. But most of the lending happens long term. So whether it be kind of business loans, auto loans, mortgages, whatever it might be, those are longer term loans. So there's a mismatch between the timing of your liabilities and the assets that you have. And then the third thing is that bankers are human. They used to be known as more kind of conservative characters during the 70s and 80s, but that's kind of gradually gone away. And they get caught up in the hype too. So during cycles, they can overextend. And when you put those three things together, what you have is an inherently unstable business model where a bank overextends at the top of a cycle, the borrowers pull their money, and that gets magnified in terms of the impact on the business because of the fractional reserves, and what you end up with is a bank run and depositors flee. Now, because of that kind of inherent instability in the banking model, you need a central bank, and there are various functions that a central bank performs that I view as extremely good and necessary. So first of all, they set the capital and reserve requirements. So the type of capital that you have to hold and the amount of leverage that you can have in the business is set by mostly these days international standards, but certainly the local kind of central bank is responsible for that. The second thing is supervising the banks and to find out who is actually kind of running into problems. And then once the banks do run into a problem, resolving that bank, so resolving bank failures. And that's actually a function that's carried out in the US by the FDIC, but in effect it's a responsibility of the central bank, and that's winding down that bank, paying back the depositors and making sure that the good loans are kind of passed on to stable banks, and then working out the bad loans in terms of the equity and bondholders in that bank. So fairly straightforward process, but you need someone to be able to come in and resolve those banks. And then lastly, because these things happen in cycles, during quiet periods of time, a few bank failures happen at a time, but during big cycles, when big cycles start to turn, you get a large number of banks going through this resolution kind of process, and that could lead to a potential systemic collapse. Now, because there's a risk of a systemic collapse, what the function that a central bank has is to be the lender of last resort. So as depositors are pulling their money out, or the banks are becoming unstable, the banks kind of come in, they lend against the assets of the bank, and they make sure they shore up the banking system, if you like. And then the last thing, a very small kind of function they play, is issuing currency. So those are the five, functions of central banking that I think are kind of all well and good, and we need that because of the inherently unstable nature of the banking business. Now, central banking has morphed over the last century, and these are the functions that they have taken on, which I don't believe are necessary. So the first thing is setting short-term interest rates, and this in many people's mind is the function that has become central for the central banks. Is the only function, the most important function that they perform is setting short-term interest rates. Well, in every other market that we have, markets set rates. Why do we need a central bank to set the rates? Markets are perfectly capable of setting rates themselves, so we don't actually need them to do that. The second thing that they've done in this last round is quantitative easing, and this is enabling endless government debts. So when governments go into deficit spending, they issue more debt, more government bonds, and if there's not someone picking up buying those government bonds at a reasonable interest rate, the central bank kind of steps in. So the central bank, the Fed in this case in the US, has stepped in and driven down those rates and allowed the federal government to deficit spend endlessly, because they're picking up, I think, about 65% of all government debt that's being issued right now. Now the Japanese have been doing this for a decade or so, and it was viewed years ago as the nuclear option. It was like the very, very last resort. This is if you had to hit the button, this is what you do. Well, now it's just become matter of fact and every day, so extraordinary. The next function that they've kind of stepped in is artificially supporting markets. So in this case we've got the GSEs. These are government sponsored entities. This is Fannie Mae, Freddie Mac, which is the mortgage market, and the central bank has been propping up the bonds of those institutions and enabling additional lending by banks that then offload those mortgage loans through Fannie and Freddie, and those bonds are being picked up by the central bank. So effectively they're artificially supporting the housing market in the US. But you could say there's a whole heap of kind of government sponsored entities. Some of the car companies in the last cycle were also supported by the government, and to some extent the central bank, lending to GMAC, the finance arm of General Motors. And then lastly, and this I think is for me is the most egregious role that the central banks have started to play in the last cycle, which is manipulating foreign rates. It's all well and good to kind of have foreign reserves, because that's keeping currency reserves on hand to enable the smooth functioning of the forex markets. But we've got to a stage where we've got central banks around the world placing bets in not just their domestic markets but the foreign markets. So they're buying foreign government and corporate bonds and equities. And so in this case we've got the Swiss bank. I think the Swiss National Bank has been the most egregious in terms of what it's doing, and it's buying euros by the truckload, and it's buying high quality, high dividend yielding equities in Europe. It's buying bonds of those kind of high quality corporates, and it's also buying government debt of all of the European countries, including some of the periphery countries that are quite unstable at the moment. So going back, these are the functions that I think the central bank are needed for, and their mandate has just been getting bigger and bigger, and it's got involved in a whole bunch of things that I just think aren't required, that we're effectively central planning. And so the central bank has become the central planner. And I think that one of the things that we've learned with the demise of communism is central planning does not work. So I'm a big believer in free markets. Free markets are not pretty, but they're beautifully efficient in terms of allocating capital and making sure prices are set correctly. And eventually intervention leads to market rigidity, and that rigidity eventually will break. So we saw that famously with George Soros. The Bank of England was trying to fix the pound versus the European currencies. Soros saw that as an opportunity, made his $1 billion by betting against the Bank of England, because there was rigidity put in between those currencies that eventually broke. The second thing is that natural systems eventually reach equilibrium. This is a bigger force than us. This is Mother Nature happening. So eventually things will reach an equilibrium. And then, bad things happen. Get over it. We don't need the government looking after us. And I'd much rather have a small series of bad things happen over a period of time and everybody get used to those than have no bad things happen over a period of a couple of decades, all of a sudden having one climactic, horrible event where we have a collapse in the system. Much better to kind of ease out the problems in the systems with having small crises every so often, rather than building everything up into one huge kind of monster crisis. And then lastly, whenever I hear the phrase unintended consequences, or CIA used to call blowback, a lot of the media pundits kind of talk about the unintended consequences of the Fed's activities and the central banks around the world. Effectively, when I hear that, what they're saying to me is, it feels bad, I just can't put my finger on why exactly it is bad, but something bad is going to happen. And I think that's right. So all of these things are about central planning, and they don't work, and eventually they will end in failure. The question is, when will they end in failure, and have we reached a limit? Certainly we've seen private debt maxed out over the last cycle, maxing out in 2007, 2008. Now subsequently that private debt has come back a little bit and stabilized, but it's not come back down to really kind of very low levels or normal levels. It's just come off an extremely high level. In the meantime, we've got government debt, we've got kind of state, municipality and sovereign debt being ratcheted up to enormous levels, and now 100% of GDP is kind of normal in terms of the debt that's been kind of amassed by government. We're also seeing marginal productivity of debt going negative. So for every extra dollar of debt, it is increasing the GDP or the growth effect by less than that dollar. So we're taking on the obligation of paying off that debt over time, but the positive impacts of using that debt are less than the cost of the debt itself. And then central bank balance sheet assets have now grown to, in the case of the developed countries, we're talking about the Bank of England, Bank of Japan, the Fed, the ECB, and so on, 20 to 35% of GDP. And in the case of the Swiss central bank, we're up to 100% of GDP. So, the levels that we're getting to are really, starting to be noticeable. Then lastly, a couple of things in terms of taxation. I think we've reached a max in terms of taxation levels and regulation, where they're actually starting to hinder economic growth going forward. And then we've also got, because of those large taxes and the large social systems that we've kind of built up, and this is kind of the benefit culture that they talk about in the UK. So we've got a culture of people that are living off the state, and in the US only 47% of people are not even paying any income tax. So we've got half of the population as being productive and adding to the economic growth of the system, and yet half the people are kind of living off the state and not adding to the productive growth of the state. So the question is, have we reached a limit in terms of all of these things? So to track the central banks and maybe some of these things starting to go wrong or unwind, I put together this handy little infographic called How to Bet Against the World's Central Banks. It's got a little bit of an intro here that just kind of went through on my slides, and then what I'm going to do is put forward 5 ETF ideas, things to track over the long term to see if some of these kind of central bank premises are starting to break down and reverse. They're kind of in a chronological order, in as much as I put forward the ideas that I think are likely to happen first at the beginning, and then kind of the ones that are less likely at the end. So the first one is the Bank of Japan, and this is short JGBs, which is Japanese government bonds. The ETF to track on this one is the JGBS. Now in all of these ETF ideas I've just used the straight ETF, no leverage kind of involved in these. I've got some really useful feedback from people, emails over the last several weeks talking about the problems with leveraged ETFs. So I've stuck with the straightforward ETFs here, and this one is short JGBs. So in terms of what the Japanese, the Bank of Japan has been doing, quantitative easing, they've been the first to do this, started in 2001, and now the government debt, the Japanese government debt as a percentage of GDP has reached 200% of GDP. Now at the same time as that debt kind of ratcheting up to just enormous levels, we've got an aging population. they've got, because of that aging population, there's fewer working Japanese. There are very few immigrants into Japan, and they're having to support the workers in Japan that are left, are having to support a lot larger retirement base, and all of this government debt that's been built up over the last 30 years effectively. So the question is, when the confidence goes in those JGBs with interest rates going up, this ETF should also rise as well. And you can see over the last couple of months we've had the first kind of spike in a long-term decline in this ETF, and the interest rates in Japan are starting to kind of spike up a little bit as the confidence in those JGBs is questioned. Now this trade is also called the Widowmaker, because this is people betting against the Japanese government over the last 15-20 years or so, and they've been wrong every time. But at some point, it does kind of work out. This is like never fight the Fed. The Widowmaker trade may actually end up being one of these kind of monster trades. So it's something to look for, and it's the ETF to track is the JGBS. The second one, and I've talked about Swiss National Bank a couple of times in the video so far, because what they've been doing is just extraordinary for a relatively small country. The size of the Swiss National Bank balance sheet now is approaching the size of the Swiss GDP. So they have printed Swiss francs to the tune of 100% of GDP in order to buy euros. When we had the financial collapse, the euro collapse in the last couple of years, all the money in Europe fled euros and went straight into Swiss bank accounts. So people were opening up Swiss bank accounts and a lot of other bank accounts around the world. We had kind of money flowing into Singapore, Hong Kong, and so on, just to escape or get to some safety in terms of, because the euro was collapsing. Now, Switzerland, being kind of geographically proximate to all of those countries, was an easy place for the money to flow, and the Swiss franc went ballistic, went nuts. What the Swiss National Bank did at that time then was intervene in the Swiss franc, and they bought euros in order to stabilize their currency and bring their currency back down to, I think the ratio is about 1.2 to the euro. So and you can see on this chart that over the last year and a half, they've kind of kept that currency pretty stable versus the euro. But at some point that's not going to work. They're going to have to either exit that trade. There's a limit to how much Swiss francs they can kind of print in order to keep that currency in check. And the assets that they bought, frankly, are just extraordinary. They bought, as I said, corporate bonds, corporate equities. They bought government bonds of not just kind of the more stable, the German Swiss bonds. They bought periphery countries as well, yielding higher yields. So the ETF to track in that case is FXF, which is the Swiss franc versus the US dollar. Next one, Bank of England. Now here we've got a new central banker. Now Mark Carney comes into the position at an interesting time where quantitative easing has gone quite a long way in the UK, and his views on whether it should be pursued or not are kind of unclear. I've kind of read stories going both ways. If the UK starts to come off quantitative easing, rates will rise. And so here we're tracking an inverse ETF, which is shorting UK gilts. So UK gilts being the government bonds in the UK, if interest rates start to rise, those bond prices will go down. So this is shorting UK gilts, and the ETF to track is XUGS. Next one, European Central Bank. So here we go, Mario Draghi. Now the European Central Bank is an interesting one because they are not directly allowed to buy government bonds of European countries. So they are not allowed officially to partake in quantitative easing. But they've gotten around it by lending to all of the major banks in the Eurozone with extremely loose capital requirements and given the money to those banks around Europe to buy the debt of different countries. So we've got German banks, for example, buying debt of the periphery countries, so they're buying Spanish bonds, Italian bonds. So although directly the European Central Bank has not bought those government bonds, it has enabled quantitative easing, and all of those bonds sit on the balance sheet of the European banks. Now if the policy of the ECB actually backfires and they're not able to keep the Eurozone together, what we could have is a splitting of the Eurozone into countries that want to keep the euro and those that don't want to keep the euro. Now, that could play out in a couple of ways and has different implications for the euro. If the periphery countries leave, so for example this is Greece, Ireland, Spain and so on leave, you're left with the stronger nations in the eurozone and the euro would actually strengthen. However, the flip side of that is that potentially the only strong country left is Germany, and that it would be administratively easier if Germany actually left and went back to the Deutschmark and everybody else was left with the euro. Now in that case the strongest player would have left and been left with the weaker players still holding on to the euro, so the euro would actually go down. So it's kind of bimodal, if you like. The euro could go up or the euro could go down. I think the more interesting play is to track what the French will do. We've got the French finance system is extremely large. We've got French banks are oversized compared to the size of their economy. They make up a large percentage of the CAC 40, which is the stock market index for the French markets. So I think the interesting play to look for here is, rather than track what the euro's doing, and we can't track kind of ECB bonds because they don't really exist, the thing to track is short the French index, and there we've got an ETF called SHC. So that's an interesting to track, and you might see that if the Eurozone starts to fall apart, that the French banks will be badly hit, and so that'll bring down the French index and short the CAC 40, which is the French index. We'd be monitoring the ETF trade SHC. And then lastly, our good friend the Fed, with Ben Bernanke, who's going to be written out of the picture come December, January. Don't know who's in, whether it's going to be Larry Summers, Janet Yellen. It's going to be interesting. And here, this is the big kind of long-term one that we should be tracking, kind of over the next several months and years, frankly. And this is if, the Fed takes its foot off the gas, if it stops quantitative easing, rates rise, and we've certainly had that in the last couple of months. We've definitely had, the treasuries kind of fall off. They've peaked at, in terms of, an important inflection point. We've had a 1% move up in rates, and the ETF to track here is short US Treasuries, and this one's a nice one, TBF, and you can see over the last couple of months certainly the volumes increased and this one started to rise. Whether we're going to have a push back down in rates, if we have a little bit of a correction in the equities market, that could drive money back into the safety of bonds, drive rates down again, and so this would correct back down and treasuries would go up for a while. But if we've reached the end of the cycle in terms of rates going down, this is the ETF to track kind of going forward. So there we go, 5 ideas in terms of ETFs to look at going forward. So now from time to time I'm going to be checking what these ETFs are doing, because a couple of them are kind of traded in overseas exchanges. I don't have direct access to the data with TradeStation. What I've done is I've just set up a little portfolio here in Google Finance. So these are the 5 ETFs that I'm looking at kind of going forward. So not suggesting we take any of these trades, they're just kind of in a wait and see kind of mode at the moment. If anything kind of moves, I think it'll be kind of the short JGBs trade that'll happen first. That'll be kind of the Hugh Hendry type model. That's the one that's likely to hit the wall first. But if that domino starts to go, then we might see some rapid changes in the other ones, with the other kind of questioning of central bank policy and what is actually possible to do with central bank policy. So let's wait and see. Kind of could be interesting, and I'll keep updating the Emini-Watch subscribers from time to time on this portfolio.